Emmanuel, am I right to maybe look at some of this weakened demand coming from earnings, or do you see a different bright spot that makes sense to have the mood music be for this quarter?
Yeah, good morning, Dani. Well, I think we've clearly seen some sign of moderating demand in US and Europe. So, as you said, that was the lowest number of beats we had in 2 or 3 years. And the mentions by companies of weaker demand, weaker economy are rising quite significantly. So there is no doubt that growth is slowing, and we are seeing that in much weaker top-line delivery. I think the bright spot may be that margins are holding up, right? So top line has basically come down, has normalized, but so far we are seeing the bulk of the corporates able to maintain fairly high margin. I suspect pricing must be offsetting some of the volume weakness we are seeing as well. So earnings have been beating estimate, less than before, but earnings are still basically delivering and growing, even though top line seems to be pointing to softer demand ahead.
Well, let's see how that top line continues. Emmanuel, good morning. It's good to see you. I like how you encapsulate the mood music. I want to understand your perception of risk. Last week was one of the best weeks in stocks that we had of 2023. But I look at what you say. We are bruised but not broken. The mood has turned decidedly risk off, with surging real rates, a higher dollar, mixed earnings, and a messy geopolitics hurting risk assets. But the sell-off in stocks is somewhat ahead of the moves in credit and earnings. However, the technicals are closer to oversold than overbought. So we're bruised but not broken. Does this mean we're putting in some kind of a base level maybe earlier in the US than we are in Europe?
Yeah, man, I think, look, you had a combination of risk-off event that, put together, hurt the market and, took market down pretty much 10% from the summer highs. And, we see a lot of, we saw some sign of capitulation, a lot of negativity in the markets. And, to some extent, our view and what you mentioned was written like a week ago before the big rally in the market. But our view was, look, it might not take much for the market to form a trading bottom. And I think the first condition for stock to stabilize is some relief on the rate side. We need to see some stability in rates, I think, for the equity market to find the floor. And look, we do believe that peak rates are in sight. We don't think we are completely done with central banks. We think the Fed might hike one more time in January, for example. The data dependency means that it's going to be very hard to get some insights from central banks for good. But, broadly speaking, we've seen rates going from 0 to 5% in the US. Most of the central banks are done with hiking rate, and that might come with a bit more stability in rates, hence help equities to form a bottom.
I'd assume that it'll take a while to really say, okay, we're stable now. We've gotten to that point because we thought we've been there before. I mean, yesterday we have someone like Kashkari coming out and saying we need to do more work. I'd rather over-tighten than under-tighten. So what happens in the meantime as we get glimmers of hope, false or not, like we did last week, that we have reached the end of the cycle? Is it just volatility from here on out?
Yeah, I think it's going to be volatility. And again, the point of being data dependent, it means central banks cannot really give some precise forward guidance from here. So, it's going to be a bit of a guess, game for the market. I mean, look, you had a significant easing in financial condition last week. Dollar was down, rates went down, equities went up. I'm not sure this is what the Fed wants. And the market is now pricing in pretty much 4 cuts by the Fed starting in May. And there is no way the Fed will accept that. So I would expect a bit of pushback on this, repricing of lower rate by the market. You have a lot of Fed speak this week. So I would expect maybe, rates volatility to resume and that to be a bit of credit check for the market. But broadly speaking, I think we are swapping, rates or rising rates for slowing growth. And as we know, on 6 months horizon, if growth is slowing, I don't think rates will be the number one concern for the market.
Right.
Yeah, but we still have quasi-QE, because if you look at what the Treasury's actually got to issue to pay, if you look at the amount of bonds they've got to issue just to pay the interest on the debt. So it's a battle royal between the Treasury and the Fed. But I'll leave you with that thought. Thanks for coming in. Hopefully the bottom is in. Emmanuel Cau, his thoughts from Barclays this morning.